Your company just announced a tender offer. Should you cash out or hold on? Before you click sell, here's what you need to know and how to avoid costly mistakes. I am AJ Ayers, co-founder of Brooklyn FI, and I am joined by my colleague, Mr. John Owens. How you doing, John?
I'm doing well, AJ. Excited to talk about tender offers here today. We're seeing a lot of these happen among our clients and prospective clients these days.
Yep. Companies are staying private longer. Liquidity is scarce, and this is a great opportunity for you, the employee at your company, to get some cash out. And by cash, we mean dollars. You've looked at your paper equity, you've seen numbers in your portal. It's not real. This is a chance to make it real and spend it on things like a house down payment, paying off loans, just having an emergency fund, or even better, my favorite, actually investing it in a diversified portfolio. So let's get into it. All right, we are calling this Love Me Tender offer. You can find lots more information than is on this video at brooklynfi.com/tender. Today, we're going to cover what a tender is, what the timeline is, should you participate, some strategies to consider, and of course, everyone's favorite, avoiding tax surprises. John, take it away.
Yeah, so what is a tender offer? A tender offer is an opportunity that your company is providing you as an employee and shareholder to sell your shares without having to go public and be traded on the stock market. Um, Many folks see this when the company is further along in their process of being private, but not ready to take that big leap of going public yet. It's a fairly standard stock sale offer that is available with specific terms on a specific time horizon at the same price among a variety of employees regulated by the SEC. Normally, it's open for about 3 weeks. And typically, AJ, we see somewhere in the 15 to 25% range of vested equity, often with a cap of how many shares you can even sell.
hmm Yeah, exactly. Your company is going to be different. Every tender is going to be different, but it's very official, right? When we think about these transactions, it's one buyer, usually it's a very large investor or an institution that wants to invest in your company. The cap table, aka the larger shareholders, they don't want to dilute themselves and they want to give you, the employees, a chance to get some cash out. So they're basically going to take orders. That's what a tender offer is, right? It's the tender offer gets opened and they said, hey, is it 5 employees that want to sell, or is it 250,000 employees that want to sell some of their vested stock? So that's why there's a very specific timeline. The orders get taken, then the transaction will close. And that's what I want to talk about is the timeline. So typically we see these announcements happen at an all hands meeting. You might hear some rumors about this ahead of time. If you're a former employee, you will probably receive this in an email. So what's unique about a tender is that the price is set. People are not going to get different prices here. There's going to be one price. And like John said, we have 20 days typically for this transaction period. Our advice to you is to get your order in as early as possible so we can make sure that your meal arrives on time, aka you don't get tripped up in these platforms and you actually get to sell your shares. So what you'll have to do is you'll log into the tender platform. You'll sign a bunch of documents. What do we usually see? We see an NDA, usually a W-9 form. You'll choose how many shares to sell. You'll tell them which bank account you want the proceeds to land in. That's real important. Don't mess those numbers up. That's an
Exactly.
important error. So once all the orders are taken, the transaction closes. The sale is finalized. The analysts and lawyers all make sure everything is buttoned up. And then they say the sale was closed. It was successful. Of course, there is a threat that this doesn't work, right? So we don't want to count our chickens before they hatch. We have seen on occasion a tender get withdrawn, like, or canceled. Just, hey, we didn't get enough orders, or the investors pulled out. And then typically we can expect your cash, your proceeds from the sale to arrive. Fastest I've seen is 2 weeks. A month is kind of standard. If you haven't received your cash after a month, definitely hit up your accounting department. And again, we have lots more information expanded beyond this presentation at brooklynfi.com/tender.
I like to think a little bit, AJ, when I think of a tender as like, hey, there's a big pizza pie and they're dividing it up among how many people there
Mm.
are. So we haven't sliced it up just yet to decide who all is going to be selling shares. But should you participate in that tender, there's a lot of considerations. There's not a one size fits all answer, but right, it's not typically requiring you to give up all of your equity. So you're still going to maintain upside in the company, participate in that future growth, but you have a chance to take some chips off the table. And we often tell folks that, hey, this is the only highly likely scenario to get some money out of the company in the near term. And you don't know what the future holds. You don't know if the IPO market could slow down. You might want to participate to take advantage of it now because of that uncertainty. You have goals that you're trying to achieve. When you sell that, you still have the upside, and you also have the ability to potentially take some of that tender offer money and reinvest it in the company stock for a more tax advantaged outcome. We'll talk about that in a second. Liquidity now reduces risk later.
Yeah, and it's not a guarantee, right? Typically, your strike price or your grant price of those original shares, it's probably lower than the tender offer. So you're going, oh, this is great. This is going to go up 600% every 3 years. I'm going to keep doing this. But that is not always the case. Over the past couple of years, we have actually seen tender offers be higher than the eventual IPO or acquisition price. So it's not that much of your holdings. And also, you don't have to sell all 20%. You can elect to sell 5%, 10%. But typically, if we're keeping over 80%, usually this is a great idea to just nab that liquidity and move on with your life is really the way I like to think about it. So some strategies to consider. Really, there's two buckets I like to think of this in. One is I've never exercised anything, or I just have RSUs. I haven't taken any action myself in the past. I've just received grants and I've worked at the company. So I've done my part. I've been paid in these grants. So if you only have RSUs, which are restricted stock units, or you only have NQOs, non-qualified stock options, you don't really have a choice, right? If you have all RSUs or all NQOs, you're just going to decide what percentage you want to sell of those and be done with it. There's not a ton of planning there. However, if you have a mix of NQOs and incentive stock options, we typically recommend using the NQOs in a tender offer. And the most important reason is that basically if you were to use your ISOs and sell those in this transaction, they would just end up being non-quals anyway because you're not going to meet the 1 year holding period that you need to grab that incentive to grab that lower tax rate with the ISOs. So if you have ISOs and non-quals and you've never exercised anything before, we'd like to call these virgin grants, then there's no reason for you to choose to exercise the ISOs. They will just become non-quals. Let's save those ISOs because we might want to exercise and hold them and be able to meet that 1 year holding period in the future. If you have shares that have been previously exercised, meaning you have maybe you participated in a previous tender offer, or maybe you early exercised all your options when you got hired. Hopefully you did. Hopefully you hired a planner like Brooklyn FI because that is really where the key planning opportunities happen. This is where the millionaires are made, is this careful long-term planning that we do. And then also the company does their part and performs pretty well when we have a great exit price. So if you have shares that you have previously exercised, this is an awesome opportunity for financial planning. First step, take a look at what you have, understand which grants are the oldest, which grants have hit certain holding periods, which grants might be non-qualified options. If you've left the company, let's confirm that they are still yours. Sometimes the accounting and sometimes the labeling is wrong in these types of accounts. So please go back and make sure. Sometimes we want to sell the most tax advantaged shares. If we have some previously exercised shares, John, that have already reached long-term capital gain status, and I'm making a bunch of money this year, I don't want to add a bunch of ordinary income to my tax return. I want to grab that lower tax rate, which I think you're about to tell us a lot more about in our next slide.
Absolutely, absolutely. So one of the things we look at with any of these transactions is how much money am I going to get out after tax? And choosing which shares you sell is going to dictate that, and as will your prior actions in terms of exercising. And so if you have RSUs that are vesting, or have already vested as part of this tender offer, or you're exercising non-qualified options, you're going to be taxed as ordinary income, right? And that is up to 37% on the federal side of things, plus state and local tax. If you're in New York City, you'll be paying both, close to 50% combined between,
It's
state.
worth it though.
Yes. If you're in New York, California, you might also be subject to Social Security and Medicare tax, subject to the wage base. But there are other pieces. If you have previously exercised ISOs, you might get long-term capital gain treatment if you've held them more than 2 years from grant, more than 1 year from the exercise. And that is 23.8% as the maximum federal rate. So you can see it's about 13, 14% discount in taxes, comparatively speaking. If you held it less than 2 years from grant, less than 1 year from exercise, it's going to be taxed as RSUs or non-qual. So if you have those where you have unexercised shares, we want to look at using those instead. And if you're saying, hey, I also need to exercise some ISOs, maybe I'm leaving a job after this tender, I have these options are going to expire, you will potentially pay alternative minimum tax. If you're going to be doing that, you want to give us a call because it is a very tricky alternative tax system and it could result in some big surprises.
Yeah. Yeah, I just want to back up and talk about like what's actually going on in a tender offer. Let's just talk about non-qualified stock options because those are sort of the easiest. So
Yeah.
what actually happens in the transaction? Because if you're an employee and you've never exercised before, all you have are these grants, right?
Yep.
So you don't actually own the stocks yet. So we're calling this a transaction, but it's actually a series of a few transactions. So what
Yep.
happens mechanically is you go into your portal, sometimes it's Nasdaq Private Markets or Carta, something like that. You go in, you say, I want to sell 20%. I've got all non-quals, no problem. It's 2,000 shares. Well, there's a strike price. You don't own those shares yet. You have to buy them. But because this is a transaction where you're selling what you have to a new buyer, what's going to happen is they're kind of behind the scenes, and the computers are going to do this without any money actually moving, is they're going to loan you the money for you to exercise those shares, and then you're going to turn around and sell it to them, and then they're going to send you the profits. So basically, the cash that you're going to get is the net between what your strike price is and what the price is that the new buyer is willing to pay, minus any taxes that get
Minus
withheld.
the tax bill. Yep.
So sometimes I just want everyone to be aware of numbers. If your strike price is $10 and the price of the tender offer is $20, you don't get $20. You get $10 because you actually had to buy that option first. So
And you
unfortunately,
probably end up getting 5 when you account for taxes.
exactly, exactly. So you might see numbers in portals and they might be saying, here's the total value of your equity. But what we're missing is the cost to exercise. So if your strike price is quite low, let's say it's under $1, we love to see a 42-cent strike price. That's awesome because the tender offer is probably 12, 15, $20. That's fantastic. That's not a ton of cash you have to pay out. So in that case, you'll have that larger profit. Whereas if you were hired, I don't know, 2 years ago, your strike price is probably something like $12, and today's tender might be something like $15 or $18. So nice profit there, but it's not $18, it's $6 if your strike price was 12. So just wanted to make that clear because I often disappoint people when I cut their perceived earnings in half.
Well, I think the one other thing to just highlight when we're
Yeah,
on the tax front,
sure.
AJ, is that oftentimes what'll happen is, yes, you'll see that gross number, and then you'll see this net number, and that net number is what ends up perhaps in your bank account. But even then, that doesn't mean all the right taxes were taken out. Sometimes there's too much taken out on the state level, too little taken out on the federal level, or vice versa. And that's where planning becomes important. I've had so many calls with folks over the years say, hey, they took the taxes out already, so I'm not worried about the taxes on this. I just don't know what to do with the cash. Just because they took out some withholding does not mean that your full tax bill is covered. We want to double check that.
Yes, especially folks, if you no longer work at the company or if you changed jobs throughout the year, just because it probably means your withholding is a little messed up. Nothing bad, just we want to make sure that we're keeping track. So our process at Brooklyn FI is to do a tax projection. Let's look at your pay stubs for everyone that's going on a tax return, you, your spouse. Let's figure out what you've withheld year to date, what you've paid in. Let's model out this transaction and see what the delta is. So that way, let's say your $100,000 profit comes in, you're excited. We can just say, oh, by the way, we're going to need 15K of that. Let's just keep it in a high yield savings account because we know that we're going to owe that to the IRS. So that way we don't have any tax surprises because nobody likes tax surprises. Speaking of surprises, if you have been at your company for a long time, I have an advanced strategy for you, which John and I have done many webinars, and we have a great podcast episode actually with an expert in this, which is QSBS, Qualified Small Business Stock. I want you to just pay attention to this. If you have previously exercised shares and you've been at the company for more than 5 years, I want you to do some research because you potentially have the opportunity to sell your shares and exclude all of your gain, pay zero tax effectively. So just wanted to put that on your radar if you've been at this company for a long time and you have actually taken action in the past, or you were granted pure shares more than 5 years ago. Fun fact, there's some new tax law coming down the pipeline, which is actually going to make QSBS even more accessible. We're going to see that 5 year period shortened in some cases. So as you are a employee of tech companies, just want you to be kind of up to date on QSBS. Happy to chat with anybody about that anytime. We do a ton of QSBS eligible transactions, and we do the reporting on the tax return. Other advanced strategy, and this is my favorite, John. This is like when I'm talking to someone and they're telling me, "Oh, I've got RSUs and I've got ISOs, I've got all the different kinds, and I'm really confused." And I'm like, "I know it's really confusing, but this is like I start salivating because I'm like, oh my God, there's so many planning opportunities here because let's use the RSUs or let's sell the shares that are long-term capital gains. Let's sell those, participate in the tender. What we've done now is pushed our income up, which gives us this really unique situation where we can potentially now use some of that cash to exercise some of our ISOs, our incentive shares that are going to potentially get that lower treatment a year from now, maybe by the time of the next tender, or even better, maybe by the time of the IPO. And that's when we see those big tax benefits. So wanted to give you folks a quick overview to equip you while you're in a tender. 3 weeks is not very long. Like we get it. It's fast. And also they can't talk about it before it happens because they don't want to spook other investors. So you probably didn't know this was coming, and that's okay. That's standard. But 3 weeks is definitely enough time to come talk to us. We'll get you a tax projection. We'll get you sorted out and make you feel really confident that you're making the right decisions. Love me tender. That's all I have to say. What about you, John?
Yeah, I think that taking advantage of liquidity when you have the opportunity to do it and going into it clear-eyed, knowing that this is a very complicated tax year and it's a lot of change, and getting that support team in place is crucial. We go through a ton of these transactions every year. We just went through a few just last month with clients. There are some open right now. And so you want folks, you might go through this once, maybe twice in your entire career. We go through it all the time, and that's really helpful to have on your side.
Yep. And my final thought is the worst thing you can do is nothing. The worst thing you can do is avoid this and wait till the last second, the day before, and then just have regret that you didn't participate. So I know it's hard. Look, we are experts in this stuff, and we are constantly baffled by how complex it is. So please reach out to someone who's been through this before, so we can hold your hand. Not that you can't handle it. You're obviously super smart. You work at a company that's doing a tender offer. That means you're really smart. So give us a call, and I hope this was helpful. You can find more information at our website. That's brooklynfi.com. We've got this recording and some more details in text format and some little graphs there at brooklynfi.com/tender. Thanks for sticking with us. John, it was great to see you.
Thanks, AJ.